All right. Thank you so much, Denny. It's always great hearing from you about the status of the AI progression in the insurance industry. I know there's always fun tidbits and looking for ways to implement it into the things that we do. So as Denny mentioned, my name is Taylor Longacre. I am a partner in Forbes Mazar's insurance practice, and I serve both our assurance and consulting service lines. Really grateful to spend time with a whole bunch of insurance professionals. The insurance industry is really near and dear to my heart. I've more or less spent my entire career serving the insurance industry outside of a small hiatus where actually I spent a lot of time with Denny in the national office for a few years and did a whole lot of how you account for me's, how you audit me's, technical consultations, ran our internal inspections process for a little while, and otherwise did a lot of things like this, which was really exciting, getting to spend time with other professionals in our industry and really work and learn together. So today, Denny has really brought you up with a whole bunch of excitement in AI, only so we can just kind of gradually come down with regulatory updates. So Connie yesterday had kind of hit the principles-based bond project in a couple of different areas, sort of targeted in her updates. This session is really meant to give you a little bit more of the how, the why, and maybe hopefully fill this out and give some more context to the principles-based bond standard. So some things that we're going to hit today. So we're going to do just some background and overview, right? So I think one of the ways that we can help make technical accounting and regulatory updates just a tad more interesting is to give a little bit of history, right? So understanding the why. Next, we're going to walk through a decision tree. So giving you some tools for how should we think about the principles-based bond standard, where we've got a whole lot of concepts flying around, and put them into sort of a cohesive thought process of the if this, then that. Then for items 3 and 4, we're going to wear an accountant carrier hat, right? And kind of look at the world from that lens and say, what kind of changes and impacts do we expect? And what are implementation considerations and best practices? Then we're going to take that hat, throw it away, and we're going to put on an investment manager hat and look at what are the investment considerations and what is the investment management community doing and thinking about the principles-based bond standard. All right. So now that we've got some background out of the way, let's talk about how we got here, right? I think before the principles-based bond standard started to get kicked around, a lot of us probably were scratching our heads saying, well, I didn't really know that we needed to redefine what a bond is. So why do we feel like we need to do that today? So I think we need to sort of rewind a little bit and think about the market environment and economics that have been going on for, let's call it the past 20 years, right? So with the exception of the past couple of years, we have had quite a prolonged period of low interest rates, which for those of us that own homes and cars and other things that we've borrowed money to be able to have, that has been awesome, right? Having cheap money is great for consumers. However, for businesses that are reliant upon investment income and conservative investments to be able to create income, that's not so great, right? So if you think about on this one end of the spectrum, we have sort of a desire from insurance carriers to be able to go and find more yield. Now, also in this period, we have had a prolific rise in private equity throughout the markets and the availability of private capital. And what that's done is really introduced a whole lot of really smart folks with some really clever ideas, and looking to deploy private capital. And one of the places that private capital has started to end up in the past several years has been insurance companies, right? So when we look at these two pieces coming together, you have, okay, I have a need on one end. Insurance carriers need some more yield, and private equity needs to deploy capital, and they say, hey, you know what? We've got some opportunity here. Perhaps we can create some interesting investments that are responsive to the needs of insurance carriers, but also deals with the fact that these insurance carriers are regulated, right? And part of that regulation is ensuring that insurance carriers are not taking on too much investment risk, right? And so when we're going to talk a lot today about risk-based capital, right? And so one of the ways that regulators are ensuring that insurance companies are acting in a manner that is supportive of the needs of policyholders and ensuring they're able to pay claims when they come up, they use risk-based capital as one of those metrics to measure them by. And so, certain types of investments carry different risk charges within that risk-based capital model. So you put all of this into our big cauldron, we stir it around, and what we end up getting are various investments that very much will say bond, right, or a fixed maturity security on the top line. And in order to be able to get some more yield, start to introduce what we'll call equity-like interests, right? And so this started to gather some attention within the NAIC. They said, okay, well, it's not that there is necessarily anything wrong with having these complex investment structures that introduce some equity-like interests. The problem is that it's more or less sort of breaks our model, right? So we have things that, aren't necessarily what we intended when we came up with the term a bond, that are getting bond RBC treatment and don't have the requisite risk charge associated with it. And they said, all right, so we need to come up with a little bit better model. So before we go any further, I just want to give sort of I'll call it poster child for our discussion today. So we're going to pick on collateralized fund obligations, or CFOs. And so for those of you that are not familiar with these types of instruments, I want you to think of something that is a special purpose vehicle. And that special purpose vehicle is going to purchase equity interest in a variety of different funds, right? Pull them all together. And then what they'll do is they will capitalize that special purpose vehicle with varying tranches of debt. And then they will go and they'll get that debt rated, right? And so they'll essentially say, okay, the first layer of debt is going to be the first money out, right? So highly likely they're going to get all of their expected principal and interest payments. So that would be pretty highly rated debt. And then we'll kind of go down the line, so on and so forth, as we get a little further in that waterfall. And then we're going to have on the back end what we'll call a residual interest, right? Or sort of an equity kicker that's going to capture everything else. And so the idea here is that, this collateralized fund obligation, right, is ultimately being collateralized by equity interest, which traditionally would be able to produce more yield, right? But now we've kind of packaged it into what looks like and smells a whole lot like a bond in the traditional sense, right? So that is sort of our poster child. And there are other things that the NAIC was looking to sort of get at with this new literature. But I want you to think about that. So now we'll go into the summer of 2019, and the NAIC had a meeting around these types of investments and said, all right, so big picture, we just really don't like the idea of introducing these equity-like interests into debt investments, and we don't want them to be on Schedule D and get bond treatment. So what they did is they said, okay, well, if we create a rule, right, a rule is something that we could maybe engineer around. So what we're going to do is we're going to have a principle. And the principle is, hey, we just don't want equity-like stuff and bond-like stuff. And it's fine if you do, but you can't call it a bond. So what that did is it said, okay, well, if we're going to say you can't have equity-like characteristics being classified as bonds, awesome. Now we need to define what does a creditor-like interest look like. And so where they really ended up is saying, okay, well, that means that we need to have a principles-based definition, which includes defining a few things. So I'm going to get this out of the way. I personally don't like when I get to see definitions in a presentation, but I feel like I get an out here given that this is an entire presentation based on a definition, and so we've got to talk about the definition. Okay. So first definition of the day. So we're going to say, what is a bond under this new principles-based bond standard? So the NAIC tells us that a bond is defined as a security which represents a creditor relationship, right? That's a key term there, creditor relationship, whereby there is a fixed schedule for one or more future payments, and which qualifies as either an issuer credit obligation, that's new, or an asset-backed security. Okay, cool. So I've got really, a few different things that I've got to think about. Then they go on to say, well, in determining whether a security represents a creditor relationship, we need to consider its substance, which is like, all right, time out. Does anybody remember when ASC 606 came out? And I know I'm kind of switching between stat and GAAP on you, but that was kind of the first instance where standard setters were now introducing a principles-based standard, right? Where we start using fun terms like in substance, right? To try to catch all. And it blew people's minds, right? This was actually, in the time when I was in the national office, and one of my responsibilities was helping to educate the firm on the new revenue recognition standard. This was something that was kind of hard for us to grasp. We, as accountants, like our checklists, right? It's either it has these characteristics or it does not. And I check the box or I do not check the box. And this, like 606, kind of says, hey, bub, you got to understand a whole lot more than necessarily what's on the page, right? And what it says at the top of the page. You actually have to sort of understand the substance, right? And so that's part of what can make this fairly challenging. But I digress. So in substance, right, rather than solely the legal form. And then we also are told that the analysis of whether the security represents a creditor relationship should also consider all other investments the reporting entity owns in the investee, as well as any other contractual arrangements. So in thinking about our example of a CFO, if you own all the debt tranches and then you also own the equity kicker, all the underlying equity interest, all the underlying interest or equity, they're going to say, hey, that sounds like the whole thing is really just a whole bunch of equity when you kind of put it all together, right? So they're getting at this concept of you need to sort of consider everything that you have in your relationship in that investee. And then sort of our piece de resistance here at the end is we're saying that a security that in substance possesses equity-like characteristics or represents an ownership interest in the issuer that does not represent a creditor relationship, right? So we get a whole lot of, shall I say, here's what it's not to help you understand what it is. Fair enough? Okay, so let's sum that up real quick. So what we heard is, hey, we've got a security, we've got contractual fixed schedule for one or more future payments. That sounds pretty familiar, so that part's good. We have to figure out this in substance creditor relationship part, right? Do we have a creditor relationship whereby we've got this predetermined principal and interest payments and that those amounts don't vary on the appreciation or depreciation of the underlying collateral or other non-debt variable, right? And the reason we wouldn't want that, because that sounds a whole lot like an equity interest, right? Like if you're exposed to variability in that underlying collateral. And then lastly, we're being told that if we are reliant on equity cash flows, underlying equity cash flows to make those principal and interest payments, we're kind of going to make an assumption that it's not a bond. Not saying it's not, but we're going to start there. Okay, I think everybody's got a participation poll. And because this is not quite as exciting as AI, you guys just get to make sure you click the button. Just tell me you're alive. All right, so we've got one F2 definitions out of the way. And now we're going to move on to say, okay, how do we take this definition and put it in a format that can kind of help us understand how to think about it and how to apply it. So what we've provided here is a simplified decision tree. So I wouldn't think of this as being all-encompassing, right? This is not going to help you answer every single question that you might have in performing an evaluation, but what it does do is sort of connect these concepts that are in some ways a little bit interconnected, as you'll see later, and try to put them in sort of a linear if this, then that type thought process. So what you'll probably notice as we walk through this is that we've got a lot of interplay with potentially other guidance, right? So it's this whole thing is sort of predicated on working towards, are you a bond? And if not, hey, guess what? You're probably something else and need to go perform an evaluation somewhere else. All right, so let's walk through each component. So first component here is, do we have a security, right? And so think like monopoly. If we are not a security, do not pass go, do not collect $200, right? We're not even getting out of the starting blocks here. All right, so here comes definition 2 of 2. So a security, we probably all kind of like, hey, I know what a security is. When I see it, I know it. But given that we are sort of, thinking about this definition of a bond holistically, I think it's helpful to bring this in as well and just sort of do a refresh, right? So what we're being told is a security is a share participation or other interest in property or in the entity of an issuer or an obligation of an issuer that has all of the following characteristics, right? So we're saying it's a piece of something that has all the following characteristics. So it is one, either represented by an instrument issued in bearer. I assume that was in the old days where you kind of had a piece of paper that said, hey, I own this, or in registered form, right? So in books and records. And if not represented by an instrument, is registered in books maintained to be recorded in transfers on or behalf of the issuer, right? So it has to be something that's written down that says you own a piece of something, right? The second part is saying it is commonly dealt in securities exchanges or markets, right? So it's something that we can exchange, right? And is a medium of investment. And then third, it is one of either a class or series that is divisible, right? So it's components of a whole. So what we're being told is, hey, it's a part of something. It could be an investment. It's got to be written down that you have an interest in this, and it's something that is exchanged, right? So we can think of a very simple example, a share of Apple. All right. With that out of the way, hey, definitions are done. Now let's kind of dig into this new component, right, which is a creditor relationship. So this is saying, do we have a creditor relationship in substance, right? So if yes, awesome. We're going to move on and figure out whether or not we're an issuer credit obligation or an asset-backed security. If not, hey, we're out of the model here, and now we need to go and look at other places, right? Could be, equities, derivatives, 21R, which will, have, potentially a lot of items ending up in this evaluation. So let's dig into what it means to be a creditor-like relationship. And so on the left-hand side of your screen, these are, think of it as indicators, right? These are indicators that a creditor relationship exists. And on the right side, we're saying these are indicators that a creditor relationship does not exist. Now, notice I said indicators, right? This is a principles-based standard, so we're not, hard and fast rules here per se. So for those of you boaters out there, think of it like channel markers, right? If you get a little closer to one channel marker, it's like, maybe in trouble. Maybe you need to come back a little bit, right? Get to the other one, maybe you need to come back, right? So indicators. Okay, so starting with a creditor relationship. So having predetermined interest in principal payments. Okay, check, that sounds good. And the contractual amounts do not vary based upon the appreciation or depreciation of the underlying collateral. Okay, that seems to make good sense, right? It should be based purely on credit. Doesn't matter what happens to maybe the operations that might support the ability to pay back that credit. all right? So we'd say to have a creditor-like relationship, you can't be impacted by that underlying variability. Okay, moving over to the other side here, if most of the debt instruments are collateralized by equity interests, right? Notice it says most debt instruments collateralized by equity interests. We'd say it's likely that's not a bond, right? Not a creditor relationship. And then we go further to say reliance of the debt instrument on the sale of underlying equity interests or refinancing at maturity, right? So we'll dig into each one of those pieces, but if those concepts exist, we're saying that a creditor relationship likely does not exist. Okay, so let's dig a little bit deeper when we say, what do we mean by debt collateralized by equity interest in this underlying presumption that if you have it, that you don't have a creditor-like relationship? So what this is saying is that to the extent that those principal and interest payments are based on the underlying cash flows associated with, say, interest in a fund, right, which would be an equity interest, right, that it feels very much like that's not really a creditor-like relationship. However, rather than just make the rule that says, hey, you can't have any of these things be bonds, they instead said, well, actually, there may be some reasonable facts and circumstances that you could say, yeah, you could be collateralized by equity interest, but it's still really more of a creditor relationship. And those facts would be that those equity interests lend themselves to predictable cash flows, and those underlying equity risks have been sufficiently redistributed. All right. And so notice that what we're doing here is we're really zeroing in on, well, what is that underlying collateral and what are those underlying characteristics? All right. So let's think about, different factors that might be here. So let's say that we have this collateralized fund obligation and the underlying equity interest is one investment in a fund. All right. It would feel pretty unlikely, right, that the credit that would be there is not going to be impacted by the underlying variability of that single credit, of that single fund that is supporting it, right? It just feels like, okay, well, we've just got equity interest here. But let's say instead that we've got lots of funds in here, and the amount of credit that's being extended is pretty small in comparison to the overall set of funds that are there. So you're over collateralized. And those funds are really diversified, right? They're in all sorts of different industries. They don't have the same seasonality. Now we start thinking, okay, well, maybe it makes sense then you could have this basket of underlying equity interests that all have varying cash flows that offset each other, and we have so much of it that it's really unlikely that even if one goes bad and maybe doesn't flow the way that we expected, that you're still going to be able to take care of the credit that's been extended. All right. So you can see that on that side of the spectrum, yeah, there are facts and circumstances where it may be reasonable to say, yeah, well, we still have a creditor-like relationship. Now, the last item here, and we will dig into this a little bit deeper as well when we get to asset-backed securities, is as that reliance on the sale of refinancing increases in order to be able to repay that debt, right? The more compelling those other factors need to be to overcome that rebuttable presumption, right? So said another way, if you have, and to give maybe an example, if the debt is just interest only, right, with a big balloon, and it's literally impossible to pay that balloon payment at the end without selling all of the underlying interests at a good price, well, it sounds like it's going to be pretty hard not to have that equity variability make its way into what we're evaluating as being a creditor relationship or not. Okay, So now let's assume that we have a creditor relationship in substance. So we're back to our chart here. And now we're going to say, great, we've got this creditor relationship. Now, what kind of bond might you be, right? So in the first bucket, we're going to say, well, is the primary source of cash flows for repayment from the operating entity, and will the issuer continuing functioning after the debt matures? So if so, then hey, guess what? We have an issuer obligation. If not, then the next question is, well, is the primary source of cash flows for repayment from the underlying defined collateral? So if the answer is no, well, hey, we might be something else. We're out of the model again. All right. But if yes, we're going to say, okay, well, are the assets owned by the issuer either financial assets, all right, we'll talk about that a little bit, or cash generating non-financial assets that provide a meaningful level of cash flows? And you hear meaningful, I'm sure a lot of you went, hey, I hear judgment again. That's fun. A meaningful level of cash flows to service the debt other than through the sale or refinancing of the underlying assets held by the ABS issuer. So that was a mouthful, right? But essentially we're saying, well, are those assets, is the instrument backed by either financial or non-financial assets, and do they provide meaningful cash flows to repay the debt? If we say yes, then our last test is, well, is the holder of that debt instrument in a different economic position than if they held those issuer assets directly, i.e., right? So am I in a different place? Do I have, some additional credit enhancement, if you will, than if I just held whatever that underlying asset is? All right, so let's go through some examples, right, of maybe what this might look like. So in our first bucket, let's talk about issuer credit obligations, right? So the key point I would like to think about here is, for an issuer credit obligation, it is expected that the issuer will continue operating after that debt is repaid, right? So I don't know about y'all, I think it's always in intro to finance class, we use like an IBM bond as like being the initial example, right? So here, think about like the IBM bond or a like US Treasury. When that debt is ultimately repaid, IBM is going to go on and continue making computers and chips, right? They don't just suddenly evaporate and go away once that debt is repaid. And same thing with the US government. And when we have an issuer credit obligation, we're told that all returns from that bond instrument in excess of the principal, that's required to be called a thing called interest. Okay, so issuer credit obligation seems pretty straightforward because it is. All right, so now asset-backed securities. These are a little bit more complicated, right? And so the way I would like to think of this is sort of that first gate is, well, hey, if you tell me an issuer credit obligation is going to continue, and that's one of the main criteria, then an asset-backed security, you could think of, the first thought is, well, this is not expected to continue after that debt matures. Also, we're told that we need to have a meaningful level of cash flows from those underlying assets that are there. Now, if it is a underlying financial asset, right? So maybe think mortgages or something like that, right? That meaningful level of cash flows is kind of obvious. If the underlying collateral is a non-financial asset, and we'll go through an example, think of something like maybe a really expensive tractor, like a combine that is going and plucking corn out of the ground. That's something that maybe takes a little bit more analysis. And then we're being told, okay, the last thing is we need to be in a different economic position versus just holding those issuer assets directly, right? And so we get this term substantive credit enhancement. So am I in a different place if I use the tractor example than if I just held the tractor, right? Do I have some additional credit enhancement that is there? So some examples of these, think collateralized loan obligations, leaseback transactions, things like that. All right, So as I brought up the example of a tractor, so let's talk through what we mean with substantive credit enhancements and being in a different economic position than owning that collateral directly. So let's use this combine as an example, right? So let's just say it's a $500,000 machine, very expensive, right? Probably needs some financing associated with it. And I can essentially try to use this tractor as an investment. And let's just use two different examples. Example one is I just purchased this tractor and I rent it to a farmer directly, right? And the second way is that I own a security in a special purpose vehicle that owns, let's just say, this tractor. And later we'll add a few more tractors for fun. But let's just say that we own this tractor in that special purpose vehicle. And then that company then leases out the tractor to the farmers. And you may say, Taylor, that sounds like semantics, and I hear you. But we'll use it as an example to kind of get through those channel markers. So in the first example, if the fair value of a tractor declines, right, and the farmer, for whatever reason, just has a bad crop and isn't able to, make good on the principal and interest payments, well, shoot, I don't really have any insulation, right, based on, let's call it that, underlying depreciation of the tractor, right? So I don't really have any substantive credit enhancement. Now, on the flip side, let's say in example two that let's just add some more tractors, right? We got a few tractors in there and we lease it to a whole bunch of different people, and the amount of, we'll call it debt, right, or creditor interest that we've got in this special purpose vehicle is actually pretty small in relation to the value of the tractors that are in this pool. And so to the extent that, maybe one of those tractors that just becomes obsolete, or you have one of those farmers just has a bad crop that year and isn't able to pay, because we are way over collateralized, somebody else, right, or something else is absorbing those losses before me, the creditor. Right. So in this example, this is how we've taken something where it is, economically similar, right? But in the way that we've structured these things, we've added credit enhancement, right? And so this is sort of an illustration of what we mean with this concept. All right. So now let's dig into meaningful cash flows, right? So as I had mentioned at the start of the ABS section, we sort of presume, right, that we've got meaningful cash flows for financial assets, right? So just think like a mortgage, right? But what about for this non-financial asset, right? And so continuing on with our tractor example, if we, and when we think about the example where we had multiple tractors and we have lots of different cash flow streams that are there, and we have over collateralized this SPV, right, in order to be able to support our credit interest, the ability for that SPV to be able to pay the principal and interest is higher, right? It's a whole lot higher. And we may not be as reliant on, say, the eventual sale of that tractor or number of tractors in order to pay back that principal, right? So as we have all of these factors here, right, we can see that how we've engineered this scenario, we've created both this substantive credit enhancement and meaningful cash flows, right? Now, if instead, let's say that we, we're very reliant on the sale of that tractor in order to pay back the principal, right? So again, using that balloon example, well, if we don't get a good price for the tractor, we may not be able to pay back that principal, right? So again, that introduces that equity-like risk into into our, what we're evaluating as being a creditor-like interest, right? And so that would be the piece that we're trying to cull out. So you can see how these two concepts interrelate a little bit. Now, you may be coming away with this going, well, gee, it certainly seems like I have to apply a ton of judgment here. And in this example that we've laid out, well, you probably might. However, the NAIC does give us a practical expedient to try to help us with this. And so when we're looking at this meaningful cash flows for a non-financial asset, so again, think about our tractor, they say, well, as long as the repayment of that principal is able to be repaid with, or sorry, I should say that differently. As long as we are only repaying something less than 50% of the original principal with the planned sale of the underlying collateral, we can say that, okay, this meets that meaningful cash flow test. Now, if we don't meet that practical expedient, so right, we don't have that 50% threshold, then we can kind of go into that further assessment, and that's where all of those various qualitative factors may come into play, right? Maybe there'll be things like, okay, well, do you have a first loss position? Where in the waterfall? How does the waterfall work? How much collateral do you have? Is it maybe just more of a timing issue, but do you have enough diversification such that, you're not pigeonholed into maybe say one tractor asset class, right? So it can get fairly complicated depending upon what it is. But it's not to say that you can't, but it is to say that threshold and the amount of information needed to support the notion that you still have a creditor-like interest in this scenario could be a lot higher. Now, just to kind of sum all of this up, when we think about this, I'm sure that you have a lot of auditors here in the audience. As we have things that need very little judgment, right, we would document probably not a whole lot. There are certain things that are even implied, right? But as significant judgment is being applied, right, the amount of documentation and evaluation of facts and circumstances and explanation of judgment goes way up as well, right? And so these would be the expectations of the NAIC should they want to dig in and ask questions. So, if a whole lot of judgment has been applied to get to a certain place, you would want to show that. All right, quick poll here. Please click the button. Let us know you're still here. Okay, we've said a whole lot about the what. So now we're going to dig in a little bit to the so what. And I think these are some things that Connie had definitely mentioned yesterday. So we'll not go into this into too much detail. But I think it's helpful now to just sort of, switch the way that we're thinking about it and say, okay, well, why do we care, right? Why do we care if a bond is no longer a bond and now has to go maybe somewhere else in our annual statement, like within Schedule BA? And the reality is it just kind of goes into our risk-based capital, right? So if we are moving from a Schedule D item to Schedule BA, that risk charge could go from a single digit to something that is substantially higher, and even quite high if you can't use the look-through approach for a life company. Another consideration here is the actual carrying value itself, right? So depending upon the NAIC rating of that bond, you may be carrying that at amortized cost or fair value, whereas on Schedule BA, you would be the lower of cost or fair value, right? So you may have some measurement differences, and you could, depending upon what moved from where, end up with some market volatility in surplus. In addition, you have diversification rules, right? So in some states, they may say that your investments should just be reasonably diversified as a prudent person would, right? So we want to make sure that we're conservative and we've got these concepts that are here, but we don't have any hard and fast rules. That's all well and good, but some states have more of a finite model, right? So thou shalt not have more than X% of this type of investment. So if a company happened to be sort of at the upper limit of X type of investment, and now we moved from one bucket to the next, we could potentially have an admissibility issue. And, I think lastly, it's a consideration of, well, what does this mean for future investment strategy for, a company that maybe we're using these types of investments to get some more yield? Do we have to change our strategy, right? Do we have to look at this maybe a different way? So I think Connie hit this as well yesterday, but I'll just kind of hit it again. So actually mechanically, how are we going to go through the transition? So let's say that we have worked through our evaluation of our security or our bond portfolio. We've identified a few bonds or a few securities now that need to be moved. What does that look like? Well, first, what we're going to do is we are going to unwind any unrealized gain or loss that might be there. And then we're going to de-recognize from Schedule D at amortized cost. And then we're going to go and we're going to put it back on Schedule BA at amortized cost. And then lastly, we're going to adjust the valuation as appropriate for Schedule BA, right? So this is that, lower of cost or fair value. And the reason that we will mechanically do it this way is to ensure that all of your schedules roll, right? We always hate getting those out of balances or things that don't reconcile, right? But this is the mechanic in which the NAIC is prescribed to make sure that happens. One thing to note here is that through this process, you should not have a recognized gain or loss, right? We're talking about unrealized potentially that may be there, but you're having no recognized gain or loss. All right, so now let's talk a little bit about implementation considerations and best practices. So, as part of putting together this this presentation and just sort of wanting to understand how has the industry been working through implementation, we've reached out to mid-sized life companies that are private equity backed to enormous multinational life companies, and just got some feedback, on a variety of different factors. And so I think it's important to kind of hear what are people seeing and things that helped it go well and things that maybe, were kind of tough. So as far as best practices, I'd say, really across the spectrum and talking with various people, they had found it helpful to really be following this standard setting process, right? So as we kind of started this discussion this morning, it's helpful to kind of understand the context, right? The how, the why, what are the different things that you're looking at, because it gives some more meat to what the standards ultimately become. And it also helps make you be familiar with where maybe some of the key issues are that may be applicable to you in your portfolio. Next, it was really a focus on project management. So really, just like any large scale project, this can look different for different kinds of companies, different sizes, and making sure that out of the gate you have a good handle on who needs to know when and what information, and being organized with what things need to happen and at what times, and having good milestones to track completion. So really having a good PM hat on here has proved to be helpful. Next, having a good classification checklist and decision tree, right? So as you are, working through your evaluation, being able to have an actionable, call it funnel, if you will, that is working to pull out things that, hey, not impacted, this is still a bond, right? That's a treasury, great. And really working down to, okay, well, what are the things that I need to truly evaluate, and how do I evaluate them, at an objective level, was really helpful in being able to make sure you could work through the process. And then lastly, just familiarity with the industry groups and the different materials that the NAIC and others have put out. So we are sort of at the eve of this standard being effective, as it's effective the first of the year. I hope that for those of you that this is, sort of a big deal and something that needs to be considered, that you've already spent a lot of time. And so this is, sort of a maybe reaffirmation of what you have been doing. But, just in an effort to kind of be, thoughtful about what this would have looked like or what it should look like, a good playbook is saying, okay, well, we should have good program management, right? So let's think about what is our implementation plan and having that being scaled for the size and complexity of our enterprise. Developing that classification checklist that kind of out of the gate, which is helpful to kind of know what is your bogey, right? What is the thing that we're trying to run down, identify, and evaluate? Working on, hey, what is the universe of investments, right? Well, fortunately, it's just everything on Schedule D, right? So having that, okay, here's our population that we're going to need to work through. And then lastly, is really just burning it down, right? It's doing the work. So, it is, we've heard from a variety of folks from, the super, super large insurers that are, working with various internal investment managers to, triage and burn down their populations, to, maybe a more centralized or outsourced approach to kind of work that funnel down, right? But at the end of the day, it's just, you kind of have to work the problem, right? Figure out how to focus on the things that are going to be impacted and then work each one of those. And, I think lastly is just understanding which groups need to be involved and when do they need to be involved, right? And so, smaller, less complex businesses, right? It may just be a couple of people. At, humongous multinationals, there may be a lot of folks that need to be involved. Everybody from accounting policy to controllership to investment accounting, capital management, leadership, you name it, right? There are lots of parties that could be impacted or need to know how the program is going. Some of the challenges and issues that we've seen, we'd say that we'd see, a fair number of securities that are being reclassified to collateral loans, right? So we'd say that we were kind of being kicked out of the, for those items that are being kicked out of our decision tree, we are seeing that land in collateral loan quite a bit. Now, one thing to think about with a collateral loan is that, yes, you're going to end up on Schedule BA, but you also, from an admissibility standpoint, need to consider the admissibility of that underlying collateral, also in the context of, if you have any, specific state requirements, right? So like, what are those individual collateral requirements to admit that asset? Also seeing some challenges with, investments that have both features of a ICO and that of an ABS. So I'll give you a quick example. So think of a municipality, right? A municipality may raise some money to, or be looking to raise funds to maybe build a road or something like that. The investment is ultimately backed by the credit worthiness of the municipality. That municipality is expected to continue on after that bond is repaid. However, the funds themselves are only there to support the building of that road, and once it's done, that SPV will just kind of go away, right? So there are instances like that require a little bit extra analysis, but these are things that the industry has now sort of worked through, and there are good Q&As to work through those issues. Some of the other things, and we'll talk a little bit more about this when we put our investment manager hat on, is, just thinking about RBC charges and those impacts. For the property and casualty, health and title companies, right, you've got a 20% charge on Schedule BA versus, maybe a single digit on Schedule D. For our life and fraternals, it's far higher, right? So if you can apply the look-through approach, maybe in some circumstances you end up about the same. If you can't, you could be as high as 45%, right? Which this could have some impacts from a capital modeling perspective. As far as some other things that we're hearing, I think I would be remiss, and Connie would probably come find me and hunt me down if I didn't mention it, is that some folks have thought that, hey, I don't need to deal with this until year-end 25. And that's just not right. That's not right, right? You have, reclassifications that would need to occur, that will impact your carrying values, right? And so this is something that really should be, if you haven't already been all the way through this, if it's applicable to you, this should be absolutely top of mind for first quarter 25. All right, quick CPE poll. Please let us know you're still here and live. Okay, as we are, sort of wrapping up here in our last section, we're going to put on our investment manager hat, right? So throwing away our carrier accountant hat and now thinking about this from an investment manager perspective. Really top of mind for all the investment managers was, well, what's going to happen with RBC, right? Are we going to suddenly see lots of assets moving from Schedule D Part 1 to Schedule BA? I think the reality is, after, maybe a lot of analysis and deliberation is that, sure, for some companies, maybe there will be some movements, but by and large, this is something that, you wouldn't expect it to be super significant as a proportion of the overall investment portfolio. Additionally, if you're moving from D to BA for a life company and you're able to apply that look-through approach, you may end up in a situation, best case, that you get a pretty similar charge, right? Worst case, yeah, sure, you could be pretty high as 45%. But the reality is that it's hard to say, in broad brushstrokes, other than this generally shouldn't be a huge proportion of companies' investment portfolios. One thing I might like to highlight here is that, maybe just from an optics perspective. So, although maybe the RBC charge, sort of stays about the same, when you move from D to BA, I think there's just sort of a maybe underlying presumption that those investments may be a little bit more opaque or more speculative, right? And that it, perhaps we're doing things to try to introduce some more yield as opposed to maybe being a little bit more risk averse, right? So maybe it's looked as turning the risk knob up a little bit. So, one big question I think investment managers have received a lot is, well, hey, do we think investment behavior is going to change, right? So, on one extreme end of the spectrum, do we expect all the carriers to go and immediately sell all of their assets that are going to be moving from D to BA? No, probably not. Again, not a huge proportion of their investment portfolios. Two, they're likely pretty illiquid, right? A lot of these things you're kind of locked up for a little while. And so, you don't really want to have to fire sale things like this if you don't have to. Now, I think it is a good thought to say, well, will we maybe change in the future, right? Will structures maybe look a little bit different? I think that remains to be seen, but I think it is a fair question, right? Folks may change, maybe their strategy and how they want to structure certain investments. But in the near term, don't really think that there's going to be some, dramatically altered investment behavior. So here we've got some charts that sort of explain and maybe just, add a little bit more meat to the concept that, hey, this isn't really a big deal for everybody, and that it's really impacting certain folks more than others. So on the left side, what you're going to see is private placement exposure by total assets, kind of split by P&C and life. As you can see, the P&C crowd, pretty small single-digit percentages. The life side obviously has got a bunch more of this stuff, right? So, when we think about who is likely impacted, I imagine all the P&C folks on this call have probably been asleep for quite some time, probably fair. And, for our life folks, definitely something to think about. But when we sort of peel a couple layers of the onion and we say, okay, well, let's sort of zero in on CLO exposure, where we think would be maybe an area that you might see some reclassifications. We see an interesting trend here in the life category where we've got, sort of this mid-size, upper mid-size life companies having a higher percentage, right, of these investments in their portfolio, right? So as we think about folks that may be more impacted, it's sort of that, medium to medium plus size life company versus maybe the uber large. So, when we think about some of these principles-based changes, do we think that this is, just sort of the NAIC saying, hey, guys, stop creating new investment types? We don't really think so. What this really does is it's just creating some alignment, right? So it's alignment between the intentions of the regulators and the structure they've developed to regulate insurance companies, and making sure that the appropriate underlying risk is being represented appropriately in these models, right? So I wouldn't see this as, hey, stop. This is let's just make sure it goes to the right place and we're thinking about things the right way. So just as, a couple of closing thoughts, right? So, some certain, we may see a little bit of a decrease in, certain synthetic securities, right? So again, now that these collateralized fund obligations have been called out, again, to just kind of pick on our poster child, we may see a little bit less of that, right? As the, strategy to try to maximize yield and minimize the capital strain has sort of gone away. But we might see a pickup, from unsuspecting investment type with convertible bonds, but that sort of remains to be seen. And just maybe one last point here with our investment manager hat. A lot of this stuff has already been underway for a long time. With third-party investment managers, would suggest that you're working closely with those investment managers in, your implementation. There are certain securities that may take a little more time to evaluate than others, but by and large, the investment managers have been working in the background to start with these reclassifications. All right, so got your last polling check mark here. Please click on that. And sort of, in close, yes, we've created something that's a little bit harder with a principles-based standard. However, I think that it's not really going to stop the investment community from, innovating and creating new investment types. It's not going to, suddenly cause insurers to go and fire sale a bunch of assets, but rather it's creating alignment in what those underlying risks and collateral is with the regulatory model. And I think Connie had presented this as well, but I think through the end of the year, you can go and watch a free webinar from the NAIC, which does a pretty good job of laying out a lot of these concepts if you'd like to see that again. So with that, I think that concludes our session here. Thank you all so very much for your attention this morning. Really appreciate the time.